Howdy there, future Texas property owners. We just finished analyzing every major Texas real estate market for 2025, and we need to warn you about something critical before you make what could be a $100,000 plus mistake. There are exactly 3 Texas cities that will absolutely destroy your wealth in 2025, and 4 cities that could make you rich. And we're about to reveal all 7 of them in the next few minutes. Here's what shocked us the most in our research. One of Texas's big 4 major cities just saw home prices crash 19% from their peak. But it's not the city you think. Meanwhile, there's a little-known military town where $254,000 homes are actually appreciating faster than Austin ever did, even during the pandemic boom. And here's the kicker that changes everything. Texas added 562,941 new residents in 2024. That's literally adding an entire city the size of Albuquerque. Yet inventory has surged 40% in major markets. This creates what we call the Texas paradox, where some cities are gold mines while others have become complete money pits, often just 50 miles apart. Now, we've got 3 specific revelations that will completely flip your understanding of the Texas market. First, which oil city has the lowest unemployment in America at 2.4%, but why touching it could bankrupt you. Second, why one of the state's biggest metros is seeing rents crash 8.2% while others surge. And third, the shocking reason why mortgage rates at 6.7% have made some Texas markets absolute steals while turning others into financial death traps. By the end of this video, you'll know exactly which 3 Texas cities to avoid at all costs and which 4 cities offer the best opportunities to build serious wealth in 2025. Let's dive into the data that separates the winners from the losers. Now, before we dive into the specific markets, let me paint you the bigger picture of what's really happening in Texas right now. We're at what we call a critical inflection point in the market. After that explosive pandemic growth that saw prices surge anywhere from 40 to 60% in major metros, Texas is experiencing some serious market correction and normalization. Statewide, median home prices have hit $335,971, but here's the real kicker. Mortgage rates sitting consistently in that 6 to 7% range have changed absolutely everything about how these markets perform. Remember I mentioned that shocking rental decline earlier? Well, that's happening in San Antonio, where rents have plummeted a devastating 8.2% year over year. We're talking about one of Texas's 4 major metros seeing rent prices crash, while most other markets are staying relatively stable. That should be your first major red flag when considering where to invest or buy. Let me start with the 3 worst markets, because honestly, these are the ones that could absolutely destroy your financial future if you make the wrong choice. Coming in at number 3 on my avoid at all costs list is San Antonio. And we're calling it the weakest major metro for a very specific set of reasons. The city is showing what we can only describe as across-the-board decline that should worry anyone thinking about putting their money here. The median home price actually fell 3% in 2024 to $308,101, making it the absolute weakest performer among Texas's big 4 metros. But it gets so much worse when you dig into the rental data. Those rental declines I mentioned earlier, San Antonio's multifamily permits crashed a staggering 73% from 2023, yet there are still thousands of units hitting the market, creating a perfect storm of oversupply. What really tells the story is that days on market have stretched to 73 to 75 days, which is the highest among all major metros. With 5.2 months of inventory sitting on the market, that's what we call deep buyer's market territory. And while that might sound good if you're buying, it signals fundamental demand weakness that could persist for years. The employment picture offers little hope for recovery either. While San Antonio added jobs at a 2.4 to 2.6% rate, these are primarily in lower wage sectors like hospitality, healthcare, and military support, not the high income positions that actually drive housing demand. For first-time buyers, I'll be honest with you, if affordability is your absolute main concern, San Antonio does offer it with a housing affordability index of 1.26, meaning median income can comfortably afford the median home. But Don't expect any equity gains anytime soon. For investors, this is where we have to be brutally honest. With falling rents, vacancy rates between 9 and 10%, and declining home prices, this investment thesis has completely collapsed. We'd recommend staying away for at least 12 to 18 months until we see clear signs of stabilization. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like, subscribe, and share helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's continue. Moving to number 2 on our worst list brings us to Permian Basin twins of Midland and Odessa. And this is where we need to reveal that oil-dependent city we mentioned with 2.4% unemployment. That's Midland. And while that unemployment number sounds absolutely fantastic, here's why smart money is running from this market as fast as they can. Approximately 20% of Midland's workforce works directly in oil and gas, making it the most petroleum-dependent major metro in all of America. Sure, median prices are up 11.5% to $368,035, and yes, they have the lowest unemployment in Texas, but this is essentially a ticking time bomb waiting to explode. Let me give you some historical context that'll chill you to the bone. During the 2014-15 oil bust, Odessa's employment plummeted 13%, losing 23,800 jobs almost overnight. The 2020 oil crash was equally devastating to both cities. What makes this even more dangerous for investors is that both cities feature highly mobile workforces, with about 20% working those 14 days on, 14 days off schedules that are common in oilfield work. This creates inherent rental instability that most people don't account for in their investment calculations. During boom times, sure, you can get great rental yields, but when the bust cycles hit, and they always do in oil markets, it's absolutely catastrophic. For first-time buyers, unless you actually work in oil and gas with what you consider secure employment, these markets are exceptionally risky. A downturn could trap you in an underwater mortgage in a declining city with limited resale options. For investors, we have to be blunt. This isn't investing. This is pure speculation. Only consider these markets if you have deep knowledge of energy markets and can afford to lose your entire equity investment. But the absolute worst market in Texas right now, taking the top spot on our avoid list, is Austin. This completely breaks our heart to say because we've watched this city for years, but Austin is experiencing what we can only call a spectacular fall from grace. The median home price has crashed from over $550,000 in April 2022 to somewhere between $445,000 and $512,500 today, depending on which measurement method you use. That's a decline of 9 to 19%, representing one of the largest price corrections among major U.S. metros. The market fundamentals paint an absolutely troubling picture for anyone thinking about investing here. Inventory has exploded to 5.7 months of supply, which is the highest level Austin has seen in 13 years, while days on market have doubled to 88 days from those pandemic lows where homes sold in 24 to 48 hours. The apartment market shows even more distress, with vacancy rates hitting 9.85%. That's nearly triple the 2021 level of 3.97% after 26,000 new units flooded the market all at once. Two-bedroom rents have plummeted 17% from their peak, dropping from $1,725 down to $1,426 monthly. Here's what's really driving this collapse. Austin's information technology sector shed 2,900 jobs in 2024, which represents a 5.7% decline. This is undermining the very foundation that drove Austin's meteoric rise in the first place. While overall unemployment remains relatively low at 3.3 to 3.5%, the loss of those high-paying tech jobs has created ripple effects throughout the entire housing market. Cap rates remain anemic at 3.34 to 3.67%, making it nearly impossible for investors to generate positive cash flow without substantial appreciation, which simply isn't happening anymore. For first-time buyers, we'll give you the one positive. You finally have negotiating power after years of being completely priced out. Homes are selling at 92 to 96% of list price, and sellers are actually offering concessions again. However, you need to understand that you're essentially catching a falling knife. Prices may continue declining through 2025. For investors, we have to say the math simply doesn't work anymore. Low cap rates, declining rents, elevated vacancy, and falling home prices create what we can only describe as a perfect storm of bad investment conditions. Now, let's shift gears and talk about the markets where you actually want to put your money. These are the 4 best Texas cities for real estate in 2025, and we're going to start with a sleeper hit that most people completely overlook. Amarillo has quietly become one of Texas's most fundamentally sound markets, and most investors have no idea this opportunity exists. This panhandle city is boasting the second lowest unemployment rate in the entire state at just 2.6% as of December 2024, which is an extraordinary indicator of economic health that you rarely see. The median home price of $247,000 represents genuine affordability, and here's the kicker. It's actually appreciating at 3.3 to 6.4% depending on the time frame you measure. What makes Amarillo so stable is its economic base, which provides the kind of stability that speculation-driven markets completely lack. Major employers include Tyson Foods, a robust healthcare sector, and diversified agriculture and manufacturing operations that are completely insulated from oil price swings or tech layoffs. The labor market strength shows up in multiple indicators. Unemployment is held between 2.6 and 3.1% for extended periods, while job growth remains steady and predictable. The market metrics show a healthy balance without any of those oversupply concerns that are plaguing other cities. Days on market at 71 days, up from 66, indicates reasonable velocity without speculative frenzy, while the sale-to-list ratio of 98% shows that sellers are pricing realistically. Building permits for single-family homes totaled 209 in the first half of 2025, down 20% from 262 in the first half of 2024, which suggests builders are being conservative, a positive sign that prevents the oversupply that's plaguing San Antonio and Austin. For first-time buyers, Amarillo offers what we call exceptional stability. You won't see 20% annual appreciation like during the pandemic craziness, but you also won't face job market volatility, declining prices, or rental oversupply. This is what we call a buy and hold for life market, where you build equity slowly but surely. For investors, that 2.6% unemployment rate creates strong rental demand, and the affordable price point means entry barriers are relatively low. Target single-family homes in that $200,000 to $280,000 range near major employers, and you'll find that cash flow is actually achievable. Moving to number 3 on our best list, we need to reveal that military town I mentioned earlier with $254,000 homes that's actually outperforming Austin. That's Killeen. And here's why this market is absolutely brilliant for both buyers and investors. The median home price of $254,000 has appreciated between 1.9 and 7.65% in 2024, which is remarkable outperformance, while those expensive markets are correcting. This represents genuine affordability. Homes are still 24% cheaper than the Texas median. But here's what makes Killeen special. What was first called Fort Hood, then Fort Cavazos, then back to Fort Hood as of June 2025, provides economic stability that very few Texas markets can match. As one of America's largest military installations, it generates consistent housing demand that's completely immune to tech layoffs, oil busts, or corporate relocations. This stability shows up clearly in the data. Home sales actually increased 7.1% year over year, even as expensive markets saw transactions plunge. Inventory remains reasonable at 5.3 months, providing buyer choice without oversupply. The Temple Killeen MSA shows population growth to 891,464, with forecasts predicting 931,992 by 2030, which represents 4.5% growth, and 978,957 by 2035, representing 9.8% growth. Unlike those boom-bust markets, this growth trajectory is steady and completely predictable. The market dynamics favor both buyers and investors in ways that most markets simply can't match. Homes move in 49 to 58 days, which is moderate velocity indicating healthy demand without speculative frenzy. For first-time buyers, if affordability is your primary concern, Killeen is simply unmatched among markets with actual job growth and appreciation. You can buy a quality 3-bedroom home for $250,000 and build equity while expensive markets stagnate. For investors, the combination of affordability, military-backed rental demand, and actual appreciation creates what we call textbook investment conditions. Number 2 on our best list is Fort Worth. And this city has officially joined America's elite tier after surpassing 1 million residents in 2024, while maintaining remarkable affordability and market fundamentals that absolutely shame its expensive neighbor Dallas. The median home price of $330,000 to $340,000 remains 15 to 20% below Dallas, while the market shows healthier velocity with homes selling in just 31 to 38 days, which is the fastest pace in all of North Texas. The investment metrics stand out dramatically when you compare them to other major markets. Cap rates of 5.6 to 5.7% make Fort Worth one of the very few major Texas markets where rental properties can still generate positive cash flow from day one. Occupancy rates hit 92.2%, with units filling in just 41 days, indicating incredibly strong tenant demand. The affordability index shows that 29.3% of homes remain affordable to median income buyers, which is far better than Dallas's 27.3% of Austin's absolutely abysmal levels. Employment growth remains robust, with expanding manufacturing, aviation through Bell Helicopter, logistics, and financial services. The city added between 23,442 and 26,927 residents annually, with growth actually accelerating rather than slowing down like we're seeing in other markets. Construction jobs increased to 37,700, and the unemployment rate of 4 to 4.1% matches or betters both state and national averages. Unlike Dallas, Fort Worth avoided the dangerous tech sector concentration that created Austin's vulnerability. For first-time buyers, Fort Worth is what we call the sweet spot. You get a genuine big city market with urban amenities, major employers, and culture, but it's still priced for median income earners. The price-to-income ratio of 3 to 3.8 times is healthy compared to Dallas's 4.4 times. For investors, the combination of sub-40 days sales velocity, 5.6% cap rates, 92.2% occupancy, and consistent population growth makes Fort Worth arguably the best risk-adjusted investment in all of Texas. But taking the top spot on our best list is Houston. And this reliable giant has emerged as Texas's most compelling major metro market by combining affordability, job growth, population expansion, and price appreciation that its peers simply can't match. The median home price of $334,900 increased between 2.7 to 5.2% year over year through 2024. Which represents the strongest performance among Texas's Big Four metros, while remaining far more affordable than Austin or Dallas. Average prices actually hit a record $443,362 in July 2024, demonstrating sustained demand despite those rising interest rates. The employment and population data reveal Houston's structural advantages that other markets lack. The metro added an impressive 81,700 jobs in the 12 months through May 2024, with unemployment holding steady at 4.2%. More impressively, Houston gained 43,217 residents from July 2023 to July 2024, which represents the second highest numeric gain in the entire United States, behind only New York City. Harris County added 32,000 housing units, which was the highest of any county nationally, yet demand continues absorbing supply, with homes moving in just 55 days on average. The rental market shows exceptional strength that investors should pay attention to. Single-family rental leases surged 3.3% to 44,551 signed in 2024, generating a record $103 million in rental volume, which represents a 6% increase year over year. This demonstrates robust tenant demand, even as other Texas markets are seeing rental weakness. The economic diversity spanning energy, healthcare through the massive Texas Medical Center that employs over 100,000 people, aerospace, logistics, and technology provides recession resistance that purely tech-dependent markets completely lack. For first-time buyers, Houston offers the best combination of affordability and appreciation potential among all major Texas metros. With inventory at 5.2 months, which is slightly elevated but not oversupplied, you actually have some negotiating leverage while still seeing price growth. For investors, strong rental demand, consistent appreciation, and cash-on-cash returns of 11 to 12% with financing make Houston what we consider the safest major metro play in Texas. Now, let me share some critical market factors that will determine success or failure in 2025. Interest rates continue controlling Texas real estate destiny in ways that no local market factor can overcome. The Federal Reserve's 3 rate cuts in 2024 failed to substantially lower mortgage rates, which remained in that 6.5% to 7% range through year end. This is more than double those pandemic-era 2 to 3% rates that millions of existing homeowners still enjoy. This creates what economists call the lock-in effect, where inventory gets suppressed as owners refuse to trade cheap mortgages for expensive ones, while simultaneously pricing many buyers completely out of the market. If rates drop to 5.5% to 6%, Texas could see explosive activity as sideline buyers rush in and locked-in sellers finally list their homes. Conversely, if inflation reaccelerates and rates spike to 7.5% to 8%, transaction volumes could create another 20% to 30%. The population growth story continues, but the composition is shifting in important ways. Texas maintained its position as America's top growth state, adding 562,941 new residents from July 2023 to July 2024, marking the 14th consecutive year leading the nation. However, net domestic migration slowed to just 85,267 people moving from other states, down sharply from pandemic peaks that exceeded 300,000 annually. The difference was made up by international migration of 319,569 and natural increase of 158,753 births exceeding deaths. While total growth remains strong, international migrants typically have lower incomes initially, supporting rental demands more than home purchases. This affects market dynamics by creating strong rental fundamentals, but weaker buyer pools in entry-level price ranges. Geographic distribution shows major metros dominating while rural areas decline, with 102 of Texas's 254 counties actually losing population. Texas issued 158,121 single-family permits in 2024, up 5.5% year over year, and the highest of any state, with December showing 17.7% month-over-month growth. However, this construction is highly concentrated geographically, creating winners and losers. The apartment market delivered 116,000-plus multifamily units in 2024. Creating the oversupply crisis now evident in Austin, Dallas, and San Antonio. The good news is that multifamily starts have crashed, with 2025 deliveries expected at just 55,000 units, less than half of 2024. This dramatic pullback will rebalance rental markets by 2026. For first-time buyers, we recommend focusing on affordability and long-term holds rather than appreciation speculation. The markets offering the best entry points are Fort Worth at $330,000 median with major city amenities, Killeen at $254,000 with military stability, and Amarillo at $247,000 with 2.6% unemployment. These cities allow you to enter with manageable payments while building equity in fundamentally sound markets. You need to avoid expensive correcting markets like Austin unless you can genuinely afford 20% plus down payments and plan to stay 7 to 10 plus years. The buy now or be priced out forever mentality that drove 2020 to 2022 panic buying has completely reversed. Inventory is increasing, days on market are lengthening, and sellers are offering concessions. You have negotiating power for the first time in years, so use it. For rental property investors, the landscape has split sharply between winners and losers. Houston and Fort Worth offer the best combination of cash flow potential, appreciation, and risk management for 2025. Focus exclusively on single-family rentals in the $250,000 to $400,000 range, as the apartment market faces 2 to 3 years of oversupply correction. For fix and flip investors, we have to tell you that this strategy faces its worst environment in a decade across most Texas markets. Days on market have doubled in many cities. Homes are selling at 92 to 98% of list price rather than over-asking with multiple offers. And buyers have regained inspection leverage. If you insist on flipping, focus only on Houston's fastest-moving submarkets where homes still sell in 55 days average. The bottom line is this. The Texas real estate frenzy of 2020 to 2022 created unsustainable conditions where typical families were priced out. Investors accepted negative cash flow betting on appreciation, and entire markets became unmoored from employment and wage fundamentals. The 2024-25 correction, while painful for those who bought at peaks, represents healthy normalization that makes home ownership and rational investing possible again. The best opportunities for 2025 exist in fundamentally sound markets that never experienced explosive bubbles. Choose Houston for major metro reliability, Fort Worth for affordability with growth, Killeen for military stability, and Amarillo for low-risk entry. Avoid Austin's correction, Midland and Odessa's oil volatility, and San Antonio's across-the-board weakness. Texas remains America's top growth state with unmatched job creation, no state income tax, and business-friendly policies attracting companies and workers. But individual market selection matters more than ever. Choose wisely, underwrite conservatively, and you'll build wealth steadily in the nation's most dynamic state. What's your take on these markets? Are you buying, selling, or holding in Texas? Drop a comment below and let us know which city surprised you most. And if this analysis helped you avoid a costly mistake or find your next investment, smash that like button and subscribe for more data-driven real estate insights. Until next time, invest smart and build wealth.